Buenas tardes a todos. Creo que ya, si no me equivoco, ya estáis entrando. Veo que se ha iniciado la sesión, con lo cual, si nadie me dice lo contrario, vamos a ir empezando. Seguramente algunos de vosotros irán conectándose, pero bueno, en todo caso, para todos, todo ok, perfecto, vale, pues empezamos. Buenas tardes a todos. Mi nombre es, para los que no me conozcáis, Dani Suyá, soy exalumni del IEF. Además, soy también colaborador académico actualmente en el IEF y en concreto soy director de desarrollo de negocio y relación con inversores entre Asset Management, la gestora de fondos y sociedades de inversión. Voy a moderar yo hoy la masterclass en Venture Capital con Scott Hartley, que ahora os lo presentaré a continuación. La sesión va a ser en inglés, eso sí. Scott entiende muy bien el castellano, pero se expresa mucho mejor en inglés. En el chat que os animo, por favor, a todos que colaboréis, que preguntéis, que hagáis lo que consideréis. Puede ser en castellano o en inglés, es indistinto. Si es en castellano yo lo considero bien, pues lo traduciréis a las paso a Scott, y si son en inglés las vamos a ver nosotros ahora en directo. Antes de presentar a Scott, dar las gracias al genial Lluís Torras, como siempre, que es el impulsor del Vespre financer y nos ha ayudado a montar y organizar este evento. Y, por supuesto, dar las gracias, como siempre, al Instituto de Estudios Financers por la organización, que tenía que ser presencial, ha acabado siendo online, ha resultado que mucha más gente también se ha inscrito, con lo cual, bueno, a ver si otra vez también lo podemos hacer presencial y hacemos el networking. Para presentar a Scott, a ver, hay muchas maneras de presentarlo. Scott es inversor a título individual, es también fundador en Venture Capital y Scott ha trabajado en Google, ha trabajado en Facebook, ha trabajado en la Casa Blanca, fue socio de uno de los mayores fondos de Venture Capital en Silicon Valley, en Sand Hill Road, que tenía el nombre, no me acuerdo el nombre del fondo de Sand Hill Road, de Scott, pero luego hablaremos. Y sobre todo la relación con TREA, pero hoy venimos a hacer una masterclass de Venture Capital, es que desde 2018 Scott fue cofundador de Everywhere Venturas, también conocido por The Fund, es marca comercial, que reinventaron mucho lo que es el negocio de Venture Capital con un modelo donde daban entrada a fundadores y a coinversores como inversores de sus fondos locales de Venture Capital, que empezaron en Nueva York y luego fueron replicando en otras ciudades en Estados Unidos. Desde 2018 han realizado más de 300 operaciones. El track record, la verdad, es que está arriba de todo de los fondos de Venture Capital. Hoy no es de lo que vamos a hablar más también de la experiencia a título personal y también como cogestor de Scott, quien ha hecho más de 75 inversiones a título personal, entre ellas destacando, por si os suena algún nombre, a Robinhood, UiPath, Kimono Labs, Lomotiv, Cover Wallet y Impress, si me he apuntado bien el nombre. Y si me permitís, no es publicidad, no es marketing, y de hecho Scott no lo tenía, pero si por no lo sabéis, Scott es autor de un libro que en castellano se llama Menos Tech y Más Platón, y la verdad es que está muy bien que alguien que viene del mundo tecnológico e ha invertido en centenares de empresas tecnológicas, que hable realmente de la importancia de no dejar de lado las ciencias sociales, las humanidades, te habla de ética, te habla de las habilidades sociales en un mundo que, como todos sabemos, ya no por la inteligencia artificial, sino en un mundo que va hacia lo tecnológico. Dicho esto, acaba mi presentación porque realmente el valor añadido hoy no soy yo, si algún día lo he sido, el valor añadido es Scott y lo dejo en esta masterclass. Por favor, yo voy a ir moderando las preguntas, ir preguntando cosas que os gustaría escuchar, porque también podemos modular la clase en esto, o cosas que según vaya diciendo Scott queráis hacer. Depende de la pregunta, igual lo interrumpo, o si no, lo dejamos hacer 40 minutos, 45 minutos y al final hacemos todas las preguntas. ¿De acuerdo? So, then I switch to English. Scott, really up to you. Thanks for being here. And please.
Well, thank you guys for joining. Thanks, Danny, for the great introduction. Have a long-standing relationship with Treya, so it's great to be back in Barcelona. I was in Madrid last week at South Summit, speaking at South Summit. So we're in Europe for basically the whole month. We spent a lot of time here in Spain, so look forward to hopefully getting to meet some of you guys in person in the future. Yeah, Danny, thanks for the shout out about the book and the funds and all the good stuff that we've been working on. I can take this conversation sort of any direction that you guys choose to. So please, comment in the question section, and we can sort of take the conversation in different directions, as this is really for you guys to learn as much as possible. And happy to be an open resource. You can find me anywhere online. LinkedIn is probably the best way to connect with me. So to give you guys a little bit of background on, I guess, myself and the evolution of starting Everywhere Ventures with my co-founder, Jenny Fielding. So I started my career growing up in Silicon Valley, kind of having the fortune of being based in Silicon Valley. So seeing the rise and fall and all the different phases of technology, so technology, as we know today, we kind of forget it's not so old. The fact that the internet, basically, barely existed in the early 1990s, and so had the fortune of, seeing things from the ground up, like Netscape get started in 1993 in my hometown, where a gentleman named Mark Andreessen was neighbors with a family friend of mine, where we would go trick-or-treating to get candy at his house. And so kind of had this very good fortune of growing up in and around technology. And then seeing the sort of the boom and the bust of the late 1990s. So moving from sort of the semiconductor world to the early internet world, to the sort of e-commerce and online sales world, to the ad tech world, which Google pioneered with the acquisition of a couple startups and the advent of creating online advertising around search results, which led to obviously the boom in Google, to then the rise of personalized internet, which was the rise of social web, and kind of what Mark Zuckerberg and Facebook pioneered 2004, 2005, followed by sort of the observation that there are all these assets around the world that are underutilized, whether they be homes, cars, anything like that. The rise of Airbnb, kind of building marketplaces on top of underutilized assets. That was the rise of the sharing economy, followed by sort of the digitization of finance, digitization of digital tokens and tools, which was the rise of Web3 and crypto. So you kind of look, from 1993 to 2023, and you think of, it's only 30 short years really of time, going from semiconductors to basically, maybe that was 83, so it gave you 10 more years, but early internet browser experience, to all things moving to the internet, to sort of the rise of ad tech, the rise of social web, sharing economy, Web3. And so, as we've sort of seen these evolutions and the booms and the busts, venture capital has also really evolved and changed. And so, we think of what we're doing with Everywhere Ventures as being kind of the third wave of venture capital. And so I think the first wave of venture capital, which really originally came from Europe. There was a gentleman who emigrated from France, taught business at Harvard Business School, kind of brought this notion that had existed in the past. It existed back in the 1500s with the Spanish galleons, going around the world, where this whole idea of carried interest has to relate to the ships and the bounty of bringing back goods and taking 20% of the goods for the pioneers on the ship and 80% of the goods going back to the crown. So this whole notion of carry and sort of this pioneering spirit has obviously existed for hundreds and hundreds of years. But I think in the modern incarnation, venture capital was brought to the West Coast from Harvard Business School and some other places in the kind of mid 1950s. And that first iteration was, if you go back to kind of the days of the Vanderbilts and the Carnegies and those large estates and families in New York and New England, they were pioneering in business, but the way they were doing that was they were sort of staking new companies. And so generally, if you wanted to start a new company, you had to go to a very wealthy patron, the Medici family in Florence or the Carnegie family in New York. You had to go sort of beg for money, and then maybe you get capital to start your business. The sort of advent of wave one of venture capital was pooled capital from third parties that was not your own. So you didn't have to be a wealthy family to invest in something. Maybe you could go and raise money from other people. That was the kind of early advent of raising a fund, charging sort of a 2 and 20, 2% management fees and 20% carry on the money that you raise, and then taking that money and being the steward or the gestora of that money, and investing it in different places. And so that was kind of, wave one, if you think about venture capital, it was going out to the market, raising third-party money from other people, pulling it into a fund, running that fund and deploying it into startups. So I'd say that was kind of wave one was, 1958 or 59 was kind of one of the early funds in Silicon Valley. It was founded by a guy named Bill Draper. And there's a great book on the whole history of venture capital that Sebastian Mallaby wrote, which I recommend. It's called, in English, it's called Power Law. I'm not sure if I'm sure it's been translated into Spanish as well. But I'm sure most of you guys can also read the English version. So that's a great book on the history of venture capital. And I had the fortune of knowing Bill Draper and introducing him to Sebastian, who wrote that book. And so kind of the ability to kind of help tell this whole story about venture capital has been an amazing part of my life. And so happy to kind of share how it works and the things that I've seen over these years. But Bill founded that fund with his father, and then Bill's son, Tim Draper, now runs another fund called Draper Fisher Jurvetson, and so that whole family has kind of remained in the lineage of venture capital. But so if you think of wave one as sort of the GP LP structure, so general partners running a fund, limited partners providing the capital. Wave two, I don't think really started until Mark Andreessen and Ben Horowitz started A16Z. Or Andreessen Horowitz, which started in about 2009, I believe. And that was the first time that I think there was real innovation around the venture model. And what they did is they actually said, well, Hollywood has this other approach where there's a group called CAA and there's a group called WME. WME is William Morris Endeavor. CAA is Creative Artist Agencies. And both of them represent Hollywood stars. So if you think of who does Tom Cruise work with, who does Penelope Cruz work with, they probably have CAA or WME as a representative of negotiating the contracts, doing the t-shirt deals, doing the concert deals, whatever it is, the movie deals. And so what Andreessen pioneered was saying, let's copy what Hollywood has, let's bring it to the Valley, and let's make it founder-centric. So let's invest money, but then when we invest the money, let's also help them with business development, with technical support, with sales and marketing, with corporate development if they want to sell the company. So they basically built a 360-degree venture fund that obviously to do that, they have to have lots of people. In order to pay lots of people, they had to raise lots of money to have 2% management fees, be able to pay the salaries of lots of people. And so they built these billion-dollar funds that were focused on kind of a 360-degree support of their portfolio. So I think that was kind of wave two. And what we've come up with what we think is wave three is basically saying, let's provide support for our portfolio, but let's do it in a decentralized way. So we actually have almost like a DeFi fund, if you will, where all of our LPs, so all of our investors in our funds are founders. So we have about 600, almost 700 founders who have put money into our funds. And we've raised 3 funds, which is about $50 million, so quite small. But those 600 people have all founded companies, they've all put money into our funds. And then in turn, we've invested that into about, so my partner Jenny and I, making all the decisions. So we're not consensus driven, we're not an angel network, we're not business angels. It's basically raising money from founders, 2 people running a fund, and we're deploying that into about 300 companies. And in turn, it's the 300 companies we've invested in are supported by us too, but also by the 600 founders that have given us the money. And so this idea that we can basically create an Andreessen Horowitz type of structure, but we can do it in a very lightweight way with 2 people and not have 100 people working for us, because we can have this decentralized approach of founders helping founders in this kind of many-to-many model of them supporting each other. So that's kind of what we think of as like wave 1, wave 2, and wave 3 of venture capital. So VC, as you guys know, typically the way I would describe this is we all might know about whiskey, and then we know about bourbon, and we know about scotch, right? Bourbon is a whiskey, but it's only from Tennessee or from the southern U.S. Scotch is a whiskey, but it's only from Scotland, right? You can't have scotch that's from Spain. You can't have whiskey that's from France. You can't have bourbon that's from France. It has to be sort of one or the other, right, based on where it's from. So I think of as you think about venture capital, venture capital is a subset of, you have public markets and you have private markets. You have public equity, you have private equity. Within private equity, you have growth capital and you have venture capital, right? So it's a subset of private equity. So venture capital is, part of private equity. I'd say it's the part that's earlier than, growth capital or, what we would call private equity, right? So if you're talking about Blackstone private equity, Treya Capital. These are companies that are doing more things in late stage growth markets than we are. So when you think about venture capital, you're not talking about public, you're talking about private. And when you're talking about private, you're really talking about early stage private. That's venture capital. And within venture capital, it goes from sort of pre-seed, seed, Series A, Series B, Series C, Series D. At some point there in the middle, you kind of start blurring the lines where it's maybe no longer venture capital, it's maybe private equity, right? And so you start to see groups like Tiger Global or Coatue or like large hedge funds that are coming down from hedge funds and public markets into private markets. And they're writing big checks into late stage venture capital rounds, which I would argue are basically private equity rounds. Maybe you could call them growth capital rounds. But they're not really doing venture capital. Venture capital to me is a different type of risk that you're taking. And so I wrote a great post a couple of days ago, which we're happy to share with you guys later. But I was trying to think through what is it that's the difference of how we take risk in different parts of venture capital, private equity and public markets. And I think the major differentiator is what I was trying to describe is that you have at the very, very early stage of a startup, for example, pre-seed. So pre-seed would typically, as we would define it, it would be, you might have friends and family. You might have raised a couple $100,000 from friends and family, but let's say your pre-seed round is probably around a $500,000 to $1.5 million round. So it would be the first institutional capital that you're raising. So institutional capital, I would define as money that's not somebody's bank account, right? So if it's Danny's bank account, my bank account, that's an angel investment. If it's not our bank account, but it's our fund bank account that we've raised from third-party people, we have LPs and we've raised a fund, that would be institutional capital. That would be a seed fund or a pre-seed venture capital fund, right? So there's a difference, I think, between angel investors, business angels, and venture capital in the sense that a business angel will take very different risks than a venture capitalist will. And the reason is because the business angel could write you a check, and they could write you a $25,000 check. If you, build a food and beverage company and you sell that company for 4 times what they invested in, they're going to be quite happy to have given you $25,000 and gotten back $100,000, right? They're thinking of it in terms of a cash on cash return, and it's a different mentality. A venture capitalist that's running a fund is typically thinking about it in much more of a portfolio approach. And so they're thinking about it as, gosh, I've raised a $25 million fund. I have X number of investments that I'm able to make with that amount of capital because I can't have an overly concentrated, portfolio. I have to divide up my risk. So I may be making 60 investments, on that capital. And so you look at those 60 investments and you think, well, half of these might not work. Half of these might work, but will be small exits. And so the ones that really work have to offset all of the losses. They have to offset all of the zeros and all of the 1 to 2x kind of middle of the road exits. And so the ones that work, actually, what you're looking for is amplitude, right? The amplitude is not just that it's a 5x, but if it could be a 50x or a 500x, that's what really drives the returns on a fund. And so the gating factor for venture capitalists will be very different in how they make decisions than from a business angel, right? A business angel will say, gosh, if I could invest 1 time and get back 4 times, that's great. That's better than me buying Google stock for the next 5 years, maybe not. But a venture fund is saying, well, I have all of these portfolio bets. I need to offset all my losses. And so I'm really not looking for a 4x return. That's, may sound greedy, but it's not greedy. It's just portfolio construction. That's what they're paid to do, is think about, well, if I need to drive multiple return on my fund, in order to do that, we could walk through the math. But for example, if you had $100 million fund, let's just make the numbers easy. And you have 50% of that is reserved for pro rata rights and for follow-on investments. So let's say you have $50 million to deploy out of your $100 million fund, and you're going to make let's say you're going to make 25 investments of $2 million a piece. Generally you're going to have certain ownership targets in the way you think about that. So you're going to say, well, if I'm making $2 million checks, I might want to own 10% of every company. And so that means that you cannot invest in any company over a $20 million valuation if you're writing a $2 million check, right? So to own 10%, you would have to cap anytime you invest at $20 million. And then when you think about half of those companies going out of business, you say, well, okay, if I have to return $100 million and I'm only going to own 10% of any company, in order to return $100 million, I actually need to generate $1 billion of market cap because I only own 10% of the billion, right? And also I need to think about the fact that I'm going to get diluted. So actually, if I'm expecting to get diluted by 50%, I might need to generate not $1 billion of market cap, but $2 billion of market cap if I'm expecting 50% dilution, let's say. So you think about that, you say, well, okay, I'm making all these investments at no greater than a $20 million entry valuation, and I need those companies to generate me $2 billion of market cap. That's a big deal, right? So that's you finding Cabify, that's you finding Global, that's you finding Uber, right? It's something that really moves the needle. So you think about, you have 25 chances, right? We're making 25 investments of $2 million. You're going to own 10% of each company, and you need to generate $2 billion of market cap to 1x your fund. Right, so that's not a good fund. That's basically you getting fired. A good fund is 2x, 3x, 4x, right? So if you think about that, you really need to generate 6 billion, 8 billion, 10 billion of market cap on 25 investments, writing $2 million checks when you have almost no information about the company, right? The company is very early and it's worth 20 million or less with probably no revenue, a small team of 10 people. And so how do you possibly do that? that's the challenge of venture capital versus growth equity versus private equity, is you don't have a lot of information. And so the article that I wrote the other day is basically about these two types of risk. And so I think at the early stages of venture capital, you have risk that I would call it existential risk. And so it's the risk that the company goes out of business, right? So when you're writing that $2 million check, you can do as much homework as you can. You can talk to the team, do reference checks, to the best of your effort, make sure that you're surrounding the team with a good support system, other good investors, like a strong syndicate that has money behind it, where if the company needs more money in the future, I can go to Danny, I can go to other members of the board maybe, and I can say, hey guys, we need to raise like another $1 million to help this company. So you can do your best to kind of play defense, but you can't really protect the whole thing forever, right? And so the risk at the early stage is existential risk that the company goes to zero. And so what that means is you have to build a big portfolio. So the only way to mitigate a bunch of things going to zero is invest in a lot of things so that even when some go to zero, you're still okay, right? If you only had a concentrated strategy of 5 investments and 5 of them go to zero, you're not in good shape, right? If you made 50 investments, so for example, our fund 1, we made 50 investments. We've had 5 go to zero. We've had 5 get acquired for small amounts. We have 40 of them that are still active, right? But so 5 of them are completely out of business. 5 of them had small exits, nothing great, but things that were, 1, 2, 3x, maybe some cash back, some stock in Facebook, some stock in other companies that maybe acquired somebody. So they're not complete zeros, but if you think about that, I would say 20% of the portfolio is gone in the form of out of business or prematurely acquired. And then 80% is active, but we still expect, half of that probably to not work. And what's really important is looking at the top 20% of that portfolio. I'd say the top 10 companies out of 50 are all backed by premier Silicon Valley funds like NEA, Sequoia, Andreessen Horowitz. And those companies are, I would say, almost in the safe zone in the sense that they've made it past the gauntlet of existential risk to now they exist, right? They're not going to go out of business tomorrow. They have a board, they have $50 million in the bank, they have a team of 200 people, they're solving a real problem. They could still, not work, but they'll not work in a different way. They probably won't go to zero, but they'll probably, get acquired, maybe for not as much. But so the risks kind of move from existential risk to price risk. And so I think the difference between an early stage venture capitalist and a growth stage or a late stage venture capitalist or a private equity person is that what I worry about is existential risk. I actually don't care that much about price risk. And of course, we're valuation sensitive. If somebody's raising at a 5 million valuation or at a 15 million valuation, it does have a difference. It definitely makes a difference on both the amount that we own when we write the same size check. But also when you think about returns, imagine getting in at 5 million or getting in at 10 million. And let's say, fast forward a few years, your investment is up 50x. In one scenario, it's up 100x in the other scenario, right? So if you think about the difference of entry valuation at the beginning, it's only the difference between 5 and 10, but on the back end, it's 2 times difference, right? So if you had a 50x return, if you got in at half the valuation, you'd have a 100x return, right? So it really does matter on valuation, but I would say the way we think about it is we focus more on existential risk, so making sure the company doesn't go to zero, than we do on deciding between a 6 million valuation and a 7 million valuation, right? If it works and it becomes Cabify or global, it's amazing either way, right? It matters a little bit on the margin. Of course, we would rather get in at 6 than at 7 or 8, but we should still make that investment, right? So we're thinking a lot more in terms of existential risk, and then we're thinking in terms of how do we sort of help this company succeed? And I think a later stage or a growth investor is, if they're entering at a Series A or Series B, there's a lot more volatility. So, at the very beginning, the difference in valuation is maybe between 5 million entry valuation and 10 million, right? And then as the company grows, at the Series A or Series B, that valuation delta or that difference might be a Series A happening at 50 million or a Series A happening at 250 million, right? And so there's a big difference there in entry valuation. And so there's a lot of price risk. So, I think one of the things that's really challenging about Series A investors, I think, so having done that, so I was as Danny mentioned, I was at a fund on Sand Hill. It was called More David Ventures. And we did Series A, Series B. And it's really difficult because it's a concentrated strategy where you're writing big checks. You might be writing a $15 or $20 million check. Of course, to write that size check, you're not doing it every day. You're doing 6 months of homework. You're talking to the founders. You're writing a 20-page deal memo. You're really doing your homework. And then you write the $15 million check, and it's scary, right? Because you're really putting all of your eggs in that basket for the next five or 10 years. So you're very disciplined about that, but you're really trying to balance between existential risks, like the company could still not work at the Series A, and you're also balancing against price risk, which you might be paying way too much money, right? And especially in a boom market or a bull market, where there's lots of competition and there's competing term sheets, and those term sheets are bidding up the price. You can really sort of fall victim to this price risk scenario where maybe you really want to get into that deal. And again, if it's global at the Series A, you don't really know that, but you should probably make that investment, right? But that's where it's very difficult, I think, at Series A and Series B, if you don't have a great pipeline of information. That's something that, when we thought and worked with Treya on being able to sort of follow on and write bigger checks into some of our, pipeline of companies, it's really because we think we have an unfair advantage of having observed all these companies for 1, 2, 3, 4, 5 years. And so at the Series A, when most people are showing up with no information and kind of completely blind, and then doing 1 month of homework and writing a big check, we can actually say, well, we have data for 5 years in these companies, and we actually think this is a good one and this one's maybe not a good one, right? So that's kind of how we think about venture capital. I can pause there. I know it's about halfway through the session, and maybe we can take some questions, or we can kind of go, different directions that you guys might find interesting.
Ahora sí que vemos el chat, que creo que estábamos en otro chat. De momento no veo preguntas. Si es que no lo estoy haciendo mal, os animo, por favor, a que compartáis vuestra experiencia en Venture Capital, preguntas que tengáis locales también para Scott. But then I think you can continue if you want, then we wait for some questions.
Yeah, for sure. So, I think the way that we make decisions, so like the role of venture capitalists really is to what we call source, select, and win the best deals. And so the way you source companies varies by stage, right? So when you think about at the pre-seed, this is finding out that a company exists and what they're working on. Generally before there's an article about the company, or there's a website, before any of those things have happened. So you might say, well, how is that possible? Well, that's really the job of becoming a VC. I had a funny story where I started in 2011 at this venture fund, and it was about my first or second week on the job, and I found out that there was a Google Ventures barbecue. And so I got in my car and I drove across the city, and I showed up and I walked around the building, and I sort of talked my way into the barbecue, and I ran into a guy that worked at Lightspeed Ventures. And we had a couple phone calls when I was interviewing, and I said to him, I said, gosh, how did you find out about this barbecue? Is there an email group, or is there some website or something I can subscribe to? And he just kind of very glibly, he just patted me on the back and he said, finding out about this barbecue is your whole job. He's like, your whole job is finding out about things that aren't published anywhere, that don't exist anywhere before anyone else knows about them. And I thought it was just a sort of interesting example of, I guess, what it's like to work in VC. And I think a lot of people, over the last 5 or 10 years have learned about venture capital and maybe aspired to do VC. I'd say it's a very challenging job in a lot of ways because you're operating fairly independently. So you're not really following guidance. It's a much more inductive job than it is deductive. You're not sort of thinking about a pipeline and then going and finding certain companies. You're much more generating a pipeline from your own sets of experiences, and finding out how you do that is sort of an exercise in personal authenticity. So, for example, at my old fund, there were some people that went to conferences and gave talks. There were some people that wrote articles and books. There were some people that sat in the office and had 15 meetings a day and talked to absolutely everybody. There were some people that went to the office on Mondays and flew to a different part of the world on Tuesday and went to sporting events and did social activities all week, right? And there was no judgment about who was working and who was not working, because actually the guy that went to all the sporting events, he found all the good deals because he was really authentic and loved American football and would take big entrepreneurs to games, and he would end up finding amazing companies to back. And so it was a very interesting endeavor in figuring out, if you have to find out about a company and win the loyalty of that entrepreneur and make the investment before somebody else, how do you do that? And I think the only way you really do that is by being genuine and authentic to yourself, right? You have to be the full version of you, whatever that means. If that means you take meetings, if that means you write books, if that means you go to sporting events. So I think that's the challenge of venture capital, is it's not a very linear, predictable job, and I think the best, the best VCs are very, very different. So you look at different people, Vinod Khosla maybe is a deep engineer who's probably an introverted guy, doesn't take a lot of meetings, but takes very specific ones. You have other people that are, highly vocal on Twitter. You have other people that do different things. But I think, the job of venture capitalists is to source, select, and win, investments. And so again, sourcing is figuring out how to find deals. What we've done is we've built a platform where, our limited partners, our LPs, are these founders. And the premise of Everywhere Ventures is we thought, if you're going to find a heart surgeon in Barcelona, I would not know how to find a good heart surgeon in Barcelona. What I would do is I might find I might say, hey, Danny, like, do you know somebody who's a surgeon in Barcelona? And he'd say, yeah, my uncle's a surgeon, right? And then I'd go to his uncle and I'd say, hey, you're a surgeon, but do you know a heart surgeon? And then I'd find the heart surgeon, and then I'd have a call with the heart surgeon, and I would say, okay, you're a heart surgeon. If you were going to have heart surgery, who would be the guy that does your heart surgery? Right? Tell me the best heart surgeon in Barcelona. And that's how I would find that person, right? I would sort of go 1, 2, 3, 4, 5 steps. And so the exact same way with finding, a company before it exists, you might say, one entrepreneur in Barcelona, and you would go talk to them and you'd say, okay, but do you know anybody in fintech? I happen to really like fintech. Can you introduce me to a few people in fintech? And you kind of follow that chain until you find, the person doing a payments company in Barcelona, and you say, well, you guys are a Series B company, but if you were writing an angel check today, who would you write a 25K check to? If you have somebody in your network that you think is amazing, and generally people would say, actually, you know what? I didn't think about this, but my old product manager, or the guy that I went to college with, he's actually starting, or she's actually starting, a neobank focused on this in Brazil, right? And so suddenly you've kind of found your way to sourcing a deal. And so think about like how you would find a doctor for a parent, or how you would find any bit of information. It's the exact same thing for a VC. And so that's kind of what we're doing all the time is following threads of introductions. That's how we fundraise. That's how we also find investment decisions. And then so that's sort of sourcing. Selecting is really a bit of I think if you play tennis. The first time you swing the racket, you're not very good. If you receive 100 tennis balls, you start to get better. And if you receive 1,000 tennis balls, you start to know which ones you want to swing at. You want to do a backhand, you want to move your feet. And so I think, the real important thing with venture is starting to get reps or repetition on deals. And so, to select the right deals, maybe at the beginning, you want to invest in a fund, right? If you're a business angel, and let's say you don't have great deal flow, you only see 10 deals a year, not 1,000 deals a year, you might be better off writing a small check into a fund, getting to know the fund, getting to see some of the deal flow, and getting to really refine your information flow. And then as you get 1,000 tennis balls, you can start to say, well, I really like this, I don't like that. And you can build your own sort of repetition. But I think that's a mistake that we see a lot, is somebody sort of says, I have lots of deal flow. I see 20 deals a month. And we say, well, we see probably 50 deals a day, so it's a different scale of deal flow. We only invest in about 1 out of 11 deals that come in from founders. And we invest in about 1 out of 3,000 deals that come in through our website. So it's a completely different level of deal flow. And so I'd say if you can get those reps and those repetitions, you can start to select better, right? So the first equation is sourcing. The second equation is selecting. And then the third equation is really winning. And winning means, what a lot of people, and including us, we really thought about critically is, we've done pretty well. We've built a small fund, but we're still not Andreessen Horowitz, right? We're not Sequoia, we're not Kleiner Perkins. And so if we went and tried to raise, a $200 million fund, maybe we could raise the money. But then the second question is, could we actually deploy the money in a smart way into the best companies? And what we really thought was, to win the deals, we actually write small checks. We can win every deal that we want to write into. But if we started wanting to write $1 million, $2 million, $5 million checks, we would start to compete with all these other big funds. And at least at this point today, we don't think we would win those deals, right? So very humbly, we said, we can source, we can select, but if we want to win deals in the best companies, we maybe can only write a $250,000 check. If we pretend we could write a $2 million check, what's going to happen is we would actually just negatively select into all the second best, third best, fourth best companies, right? And so rather than get into all the fourth best companies and write big checks and then run out of all the money, we said, no, let's write a small check and let's make sure we can get into all the best companies. And that's sort of the phase 3 is knowing where you can win and why. And I think this is another thing that I would talk about, and it's actually a piece I'm going to write in a couple of weeks, but it's about the difference between access and process. And I think as you're making your own investments, think about, why do you have access? Like, what is it specifically about you having access? And if you don't think you really have access, then you need to develop a process. And what I mean by that is, if if you're seeing something, so for example, a family office in the Middle East sends me a deal and they say, hey, we saw this random fintech company from San Francisco. It came across our desk. I'm immediately a little skeptical, because I say, I don't think the very first access to this company is going to a family office in the Middle East. I think the very first access is probably going to Mark Andreessen's email account, and the second best access is going to Reid Hoffman's email account at Greylock. And the third best access is going to whoever else, Benchmark's email address on Sand Hill Road. And then maybe the 100th best access is going to New York, and then it's the 1,000th best access is going to the Middle East. And so when I see something that says I'm coming from here, from there, I immediately say, why does this guy have the access? I don't think that they probably do. And so I'm immediately skeptical. And then I say, well, do they have a process where maybe this family office is the absolute best of the best for banking in the Middle East? And then maybe they have a process where they don't normally see all the best deals, but for all deals in a very small category, they've developed a process where they can evaluate 100 of them and they can say, this is the best one. So we actually have a team of 10 people. We've looked at 100 companies doing X, Y, and Z, and we think that this is like in the top 5. So those are two kinds of deals, right? One is from heavy access, and one is from heavy process. But I think where you really get in trouble is if you pretend that you have that same access that Andreessen has, which, even we don't pretend that. And you also don't have a process of having a staff of 10 people that looked at 100 companies, did a huge analysis, and then said, these are the top 5, right? And then they got on the phone and they called the top 5 and they tried to get investment in those companies. So I think as you're making your own angel investments, think about, what side of the coin are you on? Do you really have access? And access is not all Silicon Valley, obviously. There's incredible companies coming from all over the world. The same thing happens when we see a deal coming out of Cairo, Egypt, or Jakarta, Indonesia. When I see a deal in Jakarta, I immediately WhatsApp 10 friends of mine that run funds in Singapore, Bangkok, Jakarta, Manila, and I say, why am I seeing this? Have you guys already seen this? Have you already passed on this? Do you like this company? Do you know the founders? And so I'm immediately doing my homework locally, because I know I'm a skeptic that I have access to a great company in Indonesia. Because why would they call me, right? Why wouldn't they call the 20 funds that are already in Jakarta or in Singapore? And so I think as long as you have a lens of, why am I getting access, and do I have a process to kind of filter this? So the same thing here in Barcelona. I think a lot of you guys would have incredible access here in Barcelona or in Spain or in writ large across Europe. And so if there's a particular sector that you know well, or resource that you have access to, maybe you are seeing the best company, maybe you are seeing Cabify at a pre-seed investment, in which case you should write that check. But if you say, well, gosh, why am I the one seeing this? Has everyone else already looked at this? And am I the last person seeing this? Then, if that's the case, then you need to have a process, and maybe you need to do your homework and say, okay, I like this company, I like the sector, but let me go try to find 20 other companies that are doing this. Let me look online, let me do research, do my homework. Maybe I leverage ChatGPT or some other new tools that are out there, but I really try to figure out, who are the other 20 players doing this? And is this the absolute best one, or is this one number 9, right? If it's number 9, you probably don't want to write a check. So, that's another framework that I would think about as you're evaluating deals is, what makes you special? Why would you have access? And just really have humility with that, and know that, we recognize we don't have access to lots of things. We do have access to great companies, maybe in New York, San Francisco, LA. But if we're seeing something in Jakarta, or in Dubai, we're very quickly asking a lot of local funds, what they think, if they already looked at it, because we know that we don't have access, and we know that we need to have a process if we're going to make that kind of investment.
I think we can start with the questions. Os animo a todos, por favor, todavía tenemos 15 minutos, preguntar lo que consideréis. ¿Verdad? Yo tengo preguntas también preparadas. So Scott, Xavier Riva is asking, about what is the average time of an investment in venture capital, if these are also made for 10 years like those of private equity or common here in Spain. And also if you can, and finally, how do you see Spain as a market for the venture capital? I think you know very well Spain. So.
Thanks, Xavi. Yeah, so the average time of investment is, like you said, I mean, it really depends on what the entry point is, right? So from a pre-seed, very first check to IPO or exit, that is typically 7 to 10 years. 7 being pretty quick. When we hear about, a Instagram or WhatsApp getting acquired for these huge amounts of money, they're big newsworthy events, mainly because they're so rare, right? They're not things that happen very often. Usually, we're not seeing such quick velocity to billion-dollar outcomes in 2 years, 3 years, 4 years. And so those are the rare occasions. That's why we hear about them and read about them. So really the kind of normal story is, 7, 8, 9, 10 years. Obviously the paths to liquidity, there's kind of 3 paths to liquidity. There's a M&A kind of acquisition, right? There's IPO to public markets. And then there's a secondary transaction, right? Secondary transaction is basically, rather than creating new shares of stock and issuing new shares of stock, you're just buying existing shares of stock, either from an existing investor, which would be preferred stock, or from an existing founder or early employee, which would be common stock, right? And so oftentimes we're seeing those are the 3 paths. And I think the one change that's happened in the last maybe 2 years is people considering secondaries more now. Obviously, it's a 2-sided marketplace. And so if you want to sell, there has to be a buyer, right? So we might have a company that, we invested at a $6 million valuation. We had a company recently that raised $100 million from Andreessen. And so that was at $1 billion valuation. And so our investment, net of dilution and net of all sorts of fees is up about 60x. So, that $50,000 check, on paper is whatever, 3.2 million, let's say. And so, in theory, it should be 6 million or something more, but you take dilution. And so it's worth, 3.2. And so at that point, that's roughly returning most of that fund 1. And so there's a concept where we could say, well, maybe we would sell the whole position or part of the position to a future investor. That future investor, they would only buy it from us if they think, hey, $1 billion valuation is a great entry price, and we actually think this is a $5 billion company, and we have different risk tolerance. We want to put $3 million in, and we want to turn it into 15. And we say, well, we put 50K in, and 3 million is great, and that returns most of our funds. Maybe we're willing to sell, and so that's when a secondary transaction happens, and there's more and more platforms being built that are, integrating buyers and sellers on transactions like that. But yeah, in general, I mean, that would be, a premature sale. But the reason we would maybe do that is, one, the earlier you generate returns, obviously, the higher the IRR is. And so, IRR is a function of return, but also of time. And so if we could return capital earlier by doing secondary rather than waiting for 5 more years to maybe have IPO, maybe we do that because the IRR looks great and that helps us fundraise. It helps us tell a story to our LPs and our investors. So there's maybe a rationale for why we would sell early. The other is that, when we see public markets, and you guys know a lot about public markets, more than I do, in that zone, you go public, you have lockup periods, you have expirations of lockup periods, usually they're 6 months later. Sometimes a company goes public, they miss the first quarter or second quarter, and by the time the lockup happens, the stock is down 50%, right? And so then you say, well, if we're at $1 billion now in the private markets, and this company is going to go public at 4 billion, but then over that 6-month lockup, there's a 50% potential drop. It's only 2 billion, and that happens 5 years from now. From an IRR standpoint, we might be way better off selling today at 1 billion and just having the cash and giving it back to our investors, versus waiting for 5 more years only to have a $2 billion valuation, right? I would imagine if you ran the numbers on that, the IRR would be better selling at 1 billion today than 2 billion 5 years from now, right? And so I think those are the kind of calculations that fund managers are trying to make. And obviously now that the world has shifted so much, it becomes difficult because there's lots of funds that are thinking exactly like we are, and they say, we have all these great companies, we would be willing to sell them on the secondary market, but now there's fewer buyers, right? So of course, when you want to sell, maybe there's not a buyer. So I think those are the ways that we would look at liquidity, earlier than the 10-year time horizon. But we really, as we talk to LPs, as we talk to investors, we're trying to get personality type and somebody that's willing to go the long run. Really because this asset class, you have to think about it as pretty uncorrelated to what's happening in public markets and bonds and fixed income and all that. And think about this as the way I personally think about venture is because typically if you look at LPs, they don't just make one fund investment, they might make 5 or 10, and they make them over different vintages. And then if you think about making 5 or 10 fund investments, and then you think about in years 5, 6, 7, 8, 9, 10, really what a venture looks like is an annuity. I think it looks much more like an annuity where the returns are not predictable, but they're pretty interesting, right? You might not just get back 5% return, 5% return, 5% return, but you might get a lumpy return where one of those vintages in year 5, 6, 7, 8, 9, 10 suddenly just gives you back 3 times your money or 6 times your money or whatever it is. And so that's the way we kind of communicate to our LPs is think about this as an uncorrelated, interesting annuity where if you're backing a number of fund managers that are outliers, if you look at venture capital fund returns, it's like a bell curve, but it's really, really skewed. And so there's a long tail. And what that means is the median return and the mean return are really different, right? There's a huge differential between the median return and the mean return. And so when we talk to institutional investors, they say, we know that the median venture returns are not that great, right? But we aspire to not back median fund managers. Of course, we never want to back the middle of the road 50 percentile fund manager. We want to back the great fund manager. And so the only thing we look for is if median returns are similar to fixed income and whatever else, 9% over 10 years or something like that, not that interesting. You could do that in many different ways with less risk. But if you think you can select a manager that's going to outperform, those managers have crazy returns, right? You look at funds that actually return 100x or 50x or 10x. And so what these institutional investors that have invested with us have said is, look, when we talk to you guys, we think we don't really know if it's going to work, but we think that you guys might have an advantage on who you are, who you know, how you make decisions, and how you get deals, right? And so we think that you guys are maybe out here. We're not sure, but we don't think you're in the middle. We think you're somewhere out here. We just don't know if you're here or if you're here. And so all they're really doing is trying to buy 10 managers that are out here, right? And so I think that's the way that institutional investors think about investing in venture capital is not trying to predict everything, but it's trying to box in risk and say, well, I just don't want to back an average manager. I want to make sure the manager can compete and can differentiate on their access, again, back to how they source, how they select, and how they win. And if they can do that, then that's probably a good fund manager. And if you're building a portfolio of fund managers to back, that's how you would do it.
So we have just 10 minutes, and I think you forgot about Spain.
Spain, yeah.
Spain.
Well, so
very quickly.
So I mean, clearly, we absolutely love Spain. I mean, not only as
in terms of the sea, not in terms of beach and
in terms of Hamos Serrano for sure, and also venture capital. But I would say, we've made a few investments here in Spain. Obviously, there's immense talent, great universities, huge market. I think that Spain is also an on-ramp to Europe, and it's also an on-ramp to LATAM. And so I think we've seen a lot of amazing companies coming out of Spain with a secondary focus on Latin America. And so, that's really the interest that we have is in, backing amazing Spanish founders that have a legal domicile in Spain or a toehold in Europe, can think about the European market, and then also have a really big advantage in going into LATAM, where obviously there's another 1 billion people and huge market opportunities. So those are kind of things that excite us about Spain. We also have a lot of LPs here, so we come here a lot from a fundraising standpoint, also from an investment standpoint for portfolio. And yeah, would love to actually make more investments here. So we were able to host about 30 founders in Barcelona on Diagonal in Torrellano a couple of days ago. And we also met a bunch of folks in Madrid. So we're pretty actively looking. I'd say we invest primarily in 3 sectors. So pre-seed, so always kind of $1 million rounds at 10 million or under valuations. So the very first checks, and then primarily in fintech, digital health, and future of work. So those are the 3 areas. We kind of call that the table stakes economy. Really, kind of what do you need to live a full life, or have a full economy? It's sort of like future of work, health, and money. And so those are the 3 themes that we primarily invest in. But the last thing I'd say is when we looked at our returns, sometimes the companies that don't fit your thesis end up being the ones that are the outliers. And so I would say that even though we do focus primarily on those 3 sectors, we're also open-minded to other things. And the reason that's interesting, I think, is because you have rules, but the rules create your own guardrails. They create your own sort of barriers. And let's say, I say, Danny and I do one thing, and we say, well, the rule is that we can't do this one thing. And Danny says, well, but, I did all the homework, I figured it out, and I still think we should do it. And I say, well, no, the rule says we shouldn't do it. And you're like, I know that, but I did all the homework and I still really think we should do it. Chances are the conviction that you have to make that investment is higher. And so sometimes those end up being the great companies. And so we've actually found that we don't really do consumer investing, but some of our biggest, best companies are actually consumer companies. And it's interesting because one of us has said, well, I know we don't really do this, we don't focus on this area, but I love this founder, I love the business, and I want to do it anyway. And so I think that's something else, it's a good lesson for venture capital is it's not really a rules-based thing. It's, at the early stage, it's emotional, it's driven by charisma, it's driven by grit and gut, and the ability to sort of make things happen. And so we've had a bunch of founders that they might run out of money, they pivot the business, and then next thing you know, they're doing 10 million in revenue. And you might think it's impossible, but there's a certain personality type, and that's the type of person that we're really looking for, is that we call it a fast founder, but it's somebody, I had an experience this weekend. I was on a motorbike with a friend of mine. We went to a gas station, we threw the keys into the motorbike, it closed the lid, and the motorbike was locked. And I had to applaud my friend because within about 2 minutes, he had run into the gas station, he had paid some guys 10 euros, they had run out, they had broken apart the motorbike, they got the keys out, and we were back on the road. And I said, this is the problem solver. This is the guy that I would give a check to, because a problem that seemed impossible, he was able to fix in about 5 minutes with just charisma and personality and a few other things, right? And so those are the kind of founders and personalities, regardless of industry. So even if you're building something that's not in fintech, health, or work, drop us a line on LinkedIn, whatnot. We're happy to take a look.
Okay, so just 5 minutes, and then por favor, agregar, how do you rank potential targets by attractiveness? Do you have a systematic approach to help you to get to the right potential investments?
It's a great question. Yeah, thanks, Paul. I think, the comment I would make is we don't necessarily, I'd say it's a running list of the top of the stack. And so what's interesting about our pipeline is we have so many companies coming in. We kind of we stack rank order those by how much interest, velocity. So effectively it's when is the round closing, how imminent is the round closing, and how much do we really want to do the deal? And I'd say the guidance we give founders is, if you can kind of create enough momentum around your rounds, you force the investor to a decision where, we might be talking to 10 or 12 companies at any given time. We're only going to write one check this week or next week. So our cadence in general over the last 6 years is a pretty high cadence. We've actually invested about 1 time per week for the last 6 years. And again, these are small checks, and we're usually not the lead investor where, we're not writing all the legal docs and doing all that stuff. But still, it's a pretty high cadence to be writing one check every week, while you're also giving talks and on the road and doing all these things. And so for us, I mean, there's maybe 10 deals in play, 12 deals in play. One of them is getting done this week. It's not necessarily that, deal number 3 or number 4 is not going to happen because that one gets done, but there's kind of a running list of every day of these companies. And when one is sort of coming to fruition, they've made some progress, they closed a new client. We had another conversation with the founder, and we just had that aha moment where Jenny or myself said, I talked to that founder for the 3rd time. I really, really like what they're doing. I think we should move forward. So it's a loose answer, but I'd say our process is to continually track companies and just gather more information. And then we have this kind of stack rank list where, when something is coming together and it's sitting in the number 1 slot, chances are, we'll write the check. But that doesn't mean that the number 5 company is gone. It means the number 5 company is sitting there, and maybe it moves to number 4. And eventually maybe we lose interest, or the founder, for 3 months, 4 months, 5 months is over promising and nothing's happening. Eventually we might say, you know what, I don't think that one's going to work. And so I think advice to founders is, come in with intensity, because like, for example, if we have a conversation and then nothing happens for 6 months, we're probably going to pull the company out of that pile of the top 10. And vice versa. If you show up and a month, a week later, 2 weeks later, 3 weeks later, we're getting great information, great updates, and it seems like there's a lot of velocity with the rounds, we might jump in and say, gosh, we have to write this check. And now we're going to call up Danny and Carlos and all these other people, and we're going to help fill the round. So oftentimes when we have enough conviction, we'll jump in early, and then we'll kind of help build the team around the company. And that's generally, that would be like being a lead investor. Is, maybe we set the terms, maybe we don't, but we help kind of bring in all the other capital. And, we only do that when there's that conviction that kind of gets you off the fence. And usually that's because charisma, energy, traction, new partnership, new hire, something like that sort of changes your perspective. And you say, I went to bed last night and I woke up 3 times thinking about this company. I think we have to do it. And it's the first thing I do in the morning is write Jenny a message. Then that's when we're writing the check, right? If we kind of forget about it and it's on a list somewhere, maybe it means we shouldn't make that investment.
Okay, last question, and just 1 minute. Scott from Elohim Noya, is a fintech professor at the end. He asked, combination of venture capital investment with equity crowdfunding rounds. Your opinion, does it make sense to combine both sort of funding? But very quickly, please.
Yeah, great question. Thanks for that. I think equity crowdfunding is a complicated process. Generally, we found it to take quite a while and to not lead to huge results. So my net is, I don't think it's tier 1 capital. I think if you can really raise money from a top fund or top group of business angels, I would much prefer that. And I think the signal is much stronger that you're able to do that. I think if you run straight to crowdfunding, to me, it's a negative signal that you've probably already tried all the good funds. You've tried all the big business angels. You've kind of run out of sources, and now you're raising, in 1,000 euro tranches from a platform like that. I think if you have the right product, if you're particularly a consumer-facing product, maybe it makes sense, not so much from a fundraising standpoint, but from a customer acquisition standpoint. So I've seen that work, where you say, you filled $950,000, the last $50,000 you're doing via crowdfunding, but you're just doing it for getting some buzz, getting some PR, and getting 1,000 people to give you small checks so that they buy your product. I've seen that work pretty well. But generally for like larger rounds, I think it's more of a negative signal probably than positive.
Perfect. I had plenty of questions, but we ran out of time. So I think we have material for second and third masterclass another day if the feedback of the people are good. So thank you.
Yeah,
Thanks, Scott. Muchas gracias a todos por haber asistido a esta sesión. Ha ido un poco libre, la verdad. Si ha gustado, dejárnoslo saber, porque igual podemos montar una segunda, una tercera, porque pienso que mucha de la audiencia viene también del sector financiero bancario y podríamos hacer algo más enfocado a temas de disrupción, fintech y sector bancario. En todo caso, muchísimas gracias, Jeff. Muchísimas gracias a los asistentes. Thank you again, Scott.
Gracias a todos.
Y hasta la próxima.
Hasta la próxima.